All right, everybody. Perfect. Welcome to Finding Your Winning Go-to-Market Formula, which is a awesome partnership that has been formed between Founder Advisors, Boston New Technology, and Ecos AI. This is Steve Ilkus. I'm affiliated with Boston New Technology, but I'm going to go on ahead and turn this over to these esteemed gentlemen who decided to join us and inject their knowledge into the conversation here. So, after you guys.
Appreciate it. I'll start off on, this is Mitch. We're going to do so the topic of the day is finding your winning GTM formula. And we're probably going to have an emphasis more on the business to business, but we'll probably answer questions as needed for any of those folks who are in the B2C crowd. So we'll do introductions, then we'll get into finding the GTM formula. This could either be us presenting, then questions afterwards, but I would probably recommend just ask questions as you go, and it's probably half and half, and then we'll try to do like a little bit of next steps. What are you going to take away with this? So Hamp, you want to go first with the introduction?
Sure. Thanks everyone for your time. I know it's valuable. As Mitch said and Steve had mentioned, both of us regularly consult with startup founders and early growth stage companies. We also work extensively with a lot of VCs and angel investors. And I've had multiple exits. I've been the CRO of several companies. I've scaled a division of a private to public company. So there's a lot of miles on the experience tree, if you will, around what to do and what not to do. And I think staying attuned to the investor attitudes and preferences now is really important for any of you who are looking at getting to the next level with your company. And if you are wanting to take the plunge to do a startup, even more importantly, some of the information and wisdom we're going to share with you. One of the poignant things that we want to impress over and over again is that every startup founder that Mitch and I talk to without fail always confuses activity with results when it comes to, I got to perfect my product or my solution, or I got to hire the right person for this, or I've got to add extra things to this, or if I just get this particular account, it's going to be amazing. And that's not what investors want to see. They want to see repetitive processes that can scale a business from 0 to 5 million, 5 million to 50 million. And that's what they want to back. So we're going to tear back the layers of that insight. And we really, really encourage everybody to put questions in the chat, and we'll address them as fast as we can. Mitch?
Thank you, Hamp. Yeah, so on that point specifically, I thought I knew a thing or two, having been doing founder advisors for a little while, and go-to-market was always one of the activities that we would get involved with. And now I'm just 100% focused on that, giving the interactions with founders and giving the interactions with the investor community. And now having done a stint, and I will continue doing this go-to-market coach for a revenue accelerator for a venture capital firm, which just focuses on that. And now I've kind of have a lot more evidence to back up Hamp's point of founders busy and then going, why do I have no revenue in my pipeline? Because there's a lot of false positive. There's a lot of things that can happen to diagnose that and to help a founder then just focus in on the right activities, whether it could be related to the product, but mostly it's who you're focused on, who your customer is. And that customer might not be your ideal longer term customer and the one you envision in your mind, but it might be the one you absolutely have to build on now and build an investable revenue story. And I think folks aren't spending as much time on that. And I'm seeing now more and more reports because I'm connected to about 500 VCs and a bunch of folks who fund the VCs as well. And so the chatter around the water cooler is you got to have revenue. And I like the way Max at GrowthX characterized it, which is to say investable revenue. So just because you did a one-time, $1 million contract, et cetera, that's not a repeat customer. So they discount it from the valuation. It means nothing. Good for you. You got some non-diluted capital, but it doesn't count for what we're investing in. Anyways, So that's been my background. It slowly even more focused on this is the number one area that I think founders can get some real leg up on getting them fit for venture funding or even alternative financing. Because not everything needs to be a venture capital, funding to solve all your financing problems. So with that, let me get going. And Hamp, I'll hand it off to you, and then I will interject as we go. And then audience, feel free to ask questions as we go.
Thanks, Mitch. One of the tells that Mitch and I see when we do a postmortem with VCs about why they didn't back a particular company is reiterating something that the very, very successful and very wise personal development coach, Jim Rohn, who, if those of you who don't know who he is, Tony Robbins has built a multi-billion-dollar industry on the training he got from Jim Rohn. So this was Tony Robbins' teacher. And he made an expression all the time about nothing really happens in a business venture until you sell something. So when we look at companies that are pre-revenue and they're out there flailing, trying to get capital, this is one of the problems that the VCs look at, especially in this market now, is they want to de-risk their investments. And the first filter that they use to quantify that de-risking process is, what does your pipeline look like? Who have you engaged with? What types of clients are you talking to? And we're going to break that down a little more detail, but to give you guys an idea about how impactful revenue generation is, if you think about the premise this way, and this is straight from a VC's mouth that Mitch and I talked to not too long ago. If you take a client contract, what they're going to look at is they're going to say, okay, how much is the contract? How long is the contract? What size the company of it is, and then they're going to calculate the ARR, and they're going to say to themselves, okay, this is a 2-year contract. You're a pre-revenue company. This is your first client. It's $100,000 a year in revenue, and you have a 2-year deal, and it's a mid-tier client. They go, great. So that's your referenceable client that you can start with, and you've got a great way to look at that. And what they're going to say is, can you replicate getting more clients like that? Because the other tell that they want to look at is, if you had 5 clients and one client represents more than 50% of your revenue, that's a red flag, which is why we discourage founders from going after the shiniest, biggest logo in their swim lane, whatever business sector they're in, because it's the kiss of death. And so this also has something that's near and dear to every one of you that are founders, which is this is less dilution if you go about securing revenue first before you raise capital. Mitch.
Yep. Well, as I'm starting to find out, there's just, if you don't have a line of sight on revenue in some way, shape, or form, you're, no matter how cool or interesting you have, and let's say you answer the why this, the classic now formula, why this, why you, why now, or however, you can switch the order around, but you don't have a clear revenue story. Like, you could be great in all those areas, but they're like, but why would I want to invest now? And it's like, you're just kind of close. Why don't you go get that other piece, which is some tangible revenue of something, so that we know the market has started to give you feedback on what it is you're doing. Because without it, they're just not quite sure. And if you have those other things, you're just one step away, seemingly. And if you're even if you have like a deep tech and you have like a big hardware investment, there's other people who will fund that, grants and non-dilutive. There's other ways of skinning that cat. And most of them, unless they see a huge opportunity and you're like at a rock star team, you're like exceptional on those things, then maybe they'll give you a pass. But for the most part, no. You feel like if you're that far, you should be into revenue, or you should have some LOIs. You should have some indicator that, oh, wow, you're going to be making money in less than 18 months. Really,
exactly.
12 months, 18 months is even probably too far out, because like, they'll give themselves 6 months or more, and then you still got to be hustling to do all those things. But anyway, so I'll leave it on that. And then Hamp, I love this.
Yeah. So guys, if you think about, how a lot of people establish their ask is they come up with some kind of wonky valuation, and they come up with a number that they want to raise, but really what it translates into is they need 18 months of runway to do what? To get the revenue up to the point where they're breaking even. And again, that's another tell that VCs don't like to see. So the 4 common mistakes that we see over and over that founders make, and usually where Mitch and I parachute in to help them out, is, like I said earlier, they pursue the biggest logo in their sector. I call it the enterprise quicksand trap, because here's why. A big company is going to take your great ideas because you're nimble, you're agile, you're quick. You've come up with something that hasn't met the market yet, but is very clever solution for some systemic problems in that sector. And they're going to glean as much information out of you as they can. They might even do a proof of concept with you. And what I tell people, because I've been the CRO for 20 plus years for multiple tech companies, is that an enterprise deal takes 5 quarters historically, no matter what business sector you're pursuing. In that 5 quarters, they're going to POC you to death. They're going to reverse engineer as much as they can. They're collecting data all that time. And they still might not go with you, because at the end of the day, who's going to get fired over making a decision to go with a startup they've never heard of, that's underfinanced, doesn't have any proven track record? And so for that reason, I'm saying avoid the enterprise quicksand trap. Don't go after the biggest logo. Get your SMB and mid-tier companies going, get established, get credentials, get an advisor committee going with your clients to give you input. And that's information that's valuable about how do people use your solution. And then that gives you ammunition to go out and message new clients better in terms of their engagement and what you can do to move the needle for them. The second thing that happens, again, coincidentally, when you go after enterprise, is you discount and price your way out of the market. And I've seen this time and time again where people say, oh, we need to get this big logo, let's give them whatever price they want. No, because the one calculation that you miss out on is, what does it cost you to actually get a new client? And that's something that's a gotcha that a lot of VCs ask in their due diligence, that very, very few founders can even answer that question. How much does it cost for me to acquire a new client? The other thing that happens if you pursue an enterprise client is they suck up all the bandwidth of your team, and you don't have time to put focus on other clients to get them going, which again is a problem. Number 3 is, if you don't have a sales system and an onboarding process early, it's going to cost you a ton of money later. So I don't have a preference on the CRMs. You pick whatever you want. They're all functional. It's the data that goes into the CRMs and the process that you create about your discovery, about your assessment stage, your negotiation stage, about demo stage, about your pricing and proposal, how to get set up as a vendor with a company. Sometimes that takes 2 months. So that process, if you kick it to the curb while you're in the sales mode, then you find out everybody's warm and fuzzy, but you're going to be another 2 months from getting a contract and ultimately getting paid. So you got to have a system in place. You got to have a process. And more importantly, you got to understand why you're not getting business as opposed to what you are doing to get business, because that postmortem is critical to getting early success. And then lastly, unfortunately, a lot of my colleagues who are sales leaders get fired for the wrong reason. And a lot of times it's because they can't match with the founder, or their expertise is not a fit for an early stage company. So when you're thinking about the person, including yourself, and Mitch and I see this a lot, where we see a lot of founders who have hubris around, I'm the best salesman, I should be selling all this. When I hear that, I know that that's going to be a company that's going to crash on the rocks, because typically that's not the case. So spend a lot of time talking about and working with and figuring out who that person is in the early stages of the company that's going to lead your sales efforts. And if they're not a player coach, then that's one tell about that you're considering the wrong person. Because in all my years of doing this, I can tell you that every role I had was as a player coach. Even if I was a CRO of a very, very large company, I had a quota on purpose. Because if I couldn't teach my team how to go forward and replicate what I was doing by doing it, then I wouldn't get a lot of buy-in from my team or my sales directors or even the C-suite. The other thing, it keeps my mind and the pulse of the clients very much front center, which gives me the ability to message marketing better, message sales process better, and more importantly, lead my team by being able to say, here's how you handle this objection. Mitch?
Yeah, no, I wanted to maybe pause there for a second to see if we have questions, because those are probably like several topics. each one of the bullet points probably has it. But if there's anyone who has any questions at this point, feel free before we get going.
Sure. I'm not seeing any questions right now, so I think we can keep going.
Okay. Yeah, the picking the right person for this, I'll just chime in for a second. Depending on how early you are, like, it might need to still be the founder at all costs, as good or bad as you are, and so you need to get as much support to be the best salesperson that you're going to be for as long as you need to do that role. And I think sometimes people switch that role out as fast as possible because they don't want to be working on, they don't want to be doing sales. They want to lean into their gifts, product, vision. Generally it's product or something along those lines. And that can be a mistake, because if you're not paying attention, that's where we start finding hey, I got all these teams and they're busy and I put all the jockeys in the right seat. I got revenue. And then wow, there's a lot of people being busy and I don't really know where the problem is. And those folks are probably not going to know where the problem is either. And that's when you start deconstructing, too much focus on the top of funnel. You really don't know who your ICP is. And now that you know who it is, you're going to go back through your pipeline and have whoever's building that pipeline tell you who fits the ICP. Oh, it's less than 20%, but you're busy. And now you're actually wasting money, because 80% is not even, you're probably going to close, because you already know, you don't have enough feature. They're not at the right stage, whatever it is. And now you're burning cash faster than you can do it. And now you're spending all your time trying to raise capital because you're burning out of cash. So you kind of need to still stay out. Even if you are letting go, you need to know what to look for, and you need to still be plugged in, even if you are not going to be the sales leader. That's kind of what I'm starting to see, these patterns over and over again. Happen, if you want to chime in on that, I'm going to move to the next slide.
Yeah, go ahead, Mitch. That's okay.
Because I think here we can get that layer deeper, because not everyone's chasing the big logos to start with. Some people are. So yeah, fire away here as to kind of the breakdown of the three tiers.
So one of the things to do a critical analysis of is that your business sector, whatever it might be, is you've got three principal groups of client types, and they behave differently. And so when I was saying earlier about the SMB early adopters, it's a client that's going to be agile. They're going to be quick to adopt your product or your solution. You're going to get a lot of feedback. And most importantly, you're going to get cash flow juice, as I call it. So you're going to get revenue coming in the door, however humble it is, but it's revenue, and it's not debt, and it's not invested capital that has a dilution factor to it. And more importantly, you get people using your product or your solution, and that is the way you get better. And so the quicker you can get SMBs as early adopters, it will give you a tremendous amount of feedback also, which is very helpful. They're not going to be your mainstay, but they're going to be where you start. And then you move to the mid-tier clients, where these are great referenceable clients. They typically also have sophisticated people on the client level that's going to be able to help you, whether it's with onboarding or adoption, or more importantly, how they develop internal KPIs to measure this decision they made to go with you and your company. Those KPIs you can then translate into messaging for other clients. So you learn a lot from them. And the other thing is, it gives you an ARR impact. So if you remember the original slide, the cheapest way that you can raise money is by having at least 5 to 10 clients before you take the first investment dollar, because the ARR that those are represented is really important. And it also gives you ammunition and leverage when you're negotiating on the valuation and the discount they want and what they're going to get for what you're offering in terms of their percentage, or pricing a safe round or a seed round. And I think that's is really important. The other thing that you get from the mid-tiers is they're going to test your onboarding. They're going to test your process. So the person who owns customer success for you is going to learn a lot and be able to develop a system. And I tell a lot of people as often as I can that the second most critical hire you can make after the sales director is the customer success person, because ultimately when you've gone through all this gauntlet, you've got a paying client, you got to make them successful.
Hey,
And to
Hamp,
do that,
are
you got
people
to have
having
somebody that owns that. Go
okay,
ahead,
there you go.
Mitch.
No, you broke up for a second. I don't know if our other folks missed that.
Okay. And then what I always recommend with founders is this is your 12-month schedule, SMB and mid-tiers for 12 months. Do I say not talk to enterprise? No, you can talk to them in the first 12 months, but don't expect any revenue and don't count on them to change the scenery of your trajectory, because it takes a long time to pursue them, because they're going to ask for client references. So you need some. So you need time to get those mid-tier clients in place so you can use them as references, because you're not going to have another enterprise client like them when you pursue the first one. The other thing is that you need a much more sophisticated engagement process with them. So, and you're going to need a higher level of liability insurance and vendor protocol and everything else. And they're probably going to pay you net 75 days. So you got to be prepared to have somebody who's an accounts receivable leverage finance company lined up to take their receivables, and you can finance it to give you cash flow. So you got to have all that set up before you pursue these. So this is really important in terms of going back to what I said earlier about how most founders raise money for a runway of 18 months. This is going to cut that a lot shorter, and the VCs are going to look at this as a great de-risking, that you have a sales process without capital coming from an institutional investor or debt to get you to cash flow positive in 18 months. That's a bankable set of revenue, as Mitch said from the very beginning, that they want to back. Okay. Mitch.
Yeah. I know for some folks in the audience, they might be like, hey, we're always just going to be targeting SMB because our price point is more for a product-led growth. Either way, some of these principles are going to be good, but a lot of people and or investors do kind of want to see you going, because enterprise generally sticky customers, lots of revenue. But if you're just focused on SMB and you have more of a product-led growth sort of a strategy, you still need to sell the beginning stages until you figure it out. So a lot of this is still relevant, and you still may want to experiment with mid-tier as well. You may just not go all the way up to the enterprise life cycle. So I'm assuming that, yeah, and I don't know in the audience if we have those folks on board or not, folks who already know they're not going to be targeting the bigger enterprise. But since we're taking our time, I don't want to be in a rush to get through all the slides, because there's definitely a few more slides to go. So let's do the pricing and discounts, because this topic doesn't get talked about a lot. Hamp, you want to start it off?
One of the things that we help clients with is to do pricing formations. And what that means is that whether it's a SaaS or let's talk a SaaS product. So where a lot of founders leave money on the table, when you have a SaaS product, you're always iterating that platform. So you can create a platform license that's an annual license fee to access the platform and all the updates to a client, and they're used to paying that. So depending on the tier of client, SMB, mid-tier, or enterprise, you can set up a license fee to access your platform that's separate from the transactional way that they use it. So you have two streams of revenue you can generate from a client. And that's a real big secret that people leave money on the table by not charging a license fee. The second thing is that the number one thing that a lot of founders make the mistake of when they do discounting is they want to discount the transaction price, or in this case, a product price, or even the platform fee. What I recommend is that you discount on term. You give them 6 months of extra platform licensing for free, or you give them transaction pricing that extends beyond 12 months at a grandfathered rate as they scale up using your product or your service. And then I think the other thing too is that as soon as you go through where you're in the paperwork stage, you're getting vendors set up, you're getting a lot of things in place. You get your, as I said, accounts receivable people lined up to factor those receivables if you need to. And this all can come into play as you're moving through the negotiations process. This will save you 2 quarters of lost revenue if you take care of business like this.
I like it.
Mitch?
Did you want to go through the POC LOI vendor setup or does anyone have questions on that? Because
I've just
you kind of have to look at the
that.
full life cycle
Yeah.
of this revenue and the steps that you need to take. Or do you want to go to the next slide?
Folks are still digesting the information, so I think we can move forward.
Okay.
Okay.
All right, Hamp, you start off and I chime in.
So one of the things that we're asked a lot is about the CRMs. And obviously, if you're a pre-revenue or early growth stage company, things like Pipedrive or those other ones that are small licensees are really good. Yeah, there's probably half a dozen of them that Mitch and I recommend you can use, and they're pretty much universal. A lot of them are tied in with QuickBooks and some other things you can use and invoice out of them, and et cetera. But the main thing I say, again, over and over again, don't confuse activity with results. Don't put a bunch of company names in there, and all of a sudden you've got this inflated, distorted look of a pipeline when actually you haven't spent the time really qualifying who you're really talking to. So that's why when you set up the CRM, that the stages and being able to self-govern yourself you can't pass the next stage until you've completed all of the assessment of the previous stage. So the prospecting and qualifying is absolutely critical, because this is where you waste all your time and you get your heart broken and you run out of cash because you're talking to the wrong people. They don't have open to buy dollars. You're not talking to the decision maker. They don't want to make a pivot based on what you're doing, or you having to, if you're in a situation where competitively you're having to knock out other vendors to get your business in there, add 2 quarters to the process. If you're creating a situation where there isn't a vendor and it's a brand new decision, it's 1 more quarter usually in the process because they've got to think it through. All right. So make sure that you do a really good job of discovery and qualifying your prospects. And don't be afraid to say, like they do in the barbershop, next. If they don't qualify, move on to the next one. Don't waste time. Don't be in the hope, I wish you coulda, shoulda, world, right? Can't do it, right?
Yeah, I'll add. Start with a 3, because this is probably one of the areas I like the most. The postmortem. Oh, I think we may have lost Hamp. I'll go. So this notion of doing a postmortem, whether you get a win or a loss, but and as you're working with the client, always kind of ask yourselves, do we want more of these types of clients? And if we do, why? And then as they're getting to use the product, the reasons why they might feel they bought gives you amazing insight, because most founders are good at describing what they sell. They're not so good at describing what they think the client bought, like in their words. So you should ask them, hey, what do you think you bought? And then you get like probably things that have nothing to do with features. And you're like, oh, that's interesting. The real gold, I think, happens when, and sometimes they don't know this right away, or it might change, is why they bought. And then if that is magic, then you'd be like, oh, find me more of these people, because now I know I can just sell them with that, because that why is probably very similar. And the why gives a lot of insight into what was the triggers that got them to move. Because just saying I need them looking for a company and this is the role and it's the 30-person company, they're in this much revenue, like it doesn't really give you the reasons they're actually going to buy. Like, and it takes insight, and sometimes they're not going to even tell you right away, or your sales process, if you're not paying attention, you got to figure those things out, because Those are the ICP clues that you need to keep honing in on. And then once you have a really tight ICP, that's where you can hand off, hey, just go find these people because we know how to close them. The messaging is super tight, et cetera. And then the founder or someone else has to do all these exploratory other sectors, bigger, SMB, mid-tier, because you want the team to be very hyper-focused, because then they're not spinning their wheels, and they're just like, hey, I'm booking meetings left and right and doing demos all day long. And now we need more of a tech stack to support the demos. And do you really? So really know thy customer, and you need to constantly be spending time. So you need to be doing these analysis all the time. Existing, new, win, loss, it's nonstop until it becomes kind of second nature, because then you can start getting good at pinpointing who is our good ICP as that starts to expand in new segments. Hamp, we lost you for a little bit, but I just, over point 3, maybe you go straight into point 4, because I know there's a lot of insight there on how to.
So, I think the other thing too is, on Mitch, one more thought about that on the postmortem. You learned a tremendous amount about why people didn't buy from you, and you take that and you keep adjusting. As I like to use as an analogy, when they launched the space shuttle from Cape Canaveral, they know they're going to hit the space station, and everything that they programmed on it tells them that. But the trajectory of that space shuttle is adjusted 97% of the time when it's flying to that space station. They're constantly adjusting for conditions, atmospheric conditions. I apply that the same way to business, is that every client's different, even though they might be in the same sector. So being able to adjust and glean information and hone in on what's going to make it the closed one. And a lot of people talk about percentages. What should be the closed one when you go after SMB versus mid-tier versus enterprise? I'll give you a perspective. So think about this. When you pursue enterprise, anything that's 14% or higher as a success rate for enterprise deals is amazing. Anything above 20 is stunning. So that means 8 out of 10 you're going to lose. You're going to be in a competitive bid. You're going to be in all kinds of different situations, and that's it. For mid-tier, you're in the 40 percentile success rate. And for SMB, you should be in the high 50s. So if you're not hitting those metrics, something's wrong with your process, which is why you need to go back and do postmortem. Now, the critical thing I told you about the second most important hire is the customer success person, account manager, is because you need to plan for the first 90 days that a client uses your solution or your product all the way through. And you got to sheep herd them all the way through that process where they're hitting on all cylinders using your solution. And this is so critical, because what you don't want is to go through all this, have a client then flash out after a quarter. And now when people ask, how many clients have you signed up? Well, we have 7. How many are still retained in your service after 1 year or 6 months? And if you say only 3, that's another red flag for VCs or institutional investors. And there's a reason for that, because you don't pay attention to how people are using your product and your solution. Really critical. Mitch.
Yeah, and then obviously a lot of folks don't get into, or probably won't get into too much of this, but a lot of these customers are the ones you're going to upsell to those other premium things as you start building other feature sets. So you really don't want to lose them, because they're the easiest ones to close. Plus, they're all the referral. A lot of that juice, you lose a lot of air out of the room when you lose them, because so much goes away when that happens. So the onboarding piece and the customer success piece is key, and also those people can be frontline to not having the sales team or the product visionary trump what customers and the next set of customers really need from the product roadmap. And if that just gets left aside, then you don't have sort of an anchor, the customer voice, which some teams are better at it than not, because the founder or whoever, or the salesperson, they know not to get too far ahead and just sell stuff that we don't have. Although I'm a big fan of selling and then building later. And then what Hamp put here is you can start leveraging them for referrals. Enterprise can be a little bit harder, but that whole referral engine is great. If you can start getting it, the sooner you can get it. But if you don't have this piece, it's going to be very, very hard. That's all I have for that. Let me switch because I know we still have some other slides. Yeah, we still have a couple of slides, and I want to have room for people to ask questions. Yeah, we got to get going. Move. Ham, are you there?
Yep, I'm here. So in terms of the search and interview process, I think that there's a big trap that people fall into, is that they tend to recruit people like them, and that's a huge mistake. Both personality, skill set, age, etc. So don't be the author of wanting to hire people like yourself. You want to stretch your search, and you want to listen to a lot of people, and you're going to learn a lot of things about your company and what people do and their intrinsic skills and aptitude. And so I think that you need to have a really open mind. I think you need more than one person making the decision with you about hiring the people. The first 4 or 5 hires. And I think the second thing is that you also need to be able to be okay with not getting the best person, because it might come down to a problem of compensation. A lot of people are scared about going to work for pre-seed or seed round companies because they don't think they're going to make it. So they're going to be asking you a lot of questions about your financial integrity, because they're going to be concerned that I don't want to switch jobs, even if they've been looking for a job for a while, and only to crash and burn. So be prepared to address those questions and be very transparent, because if you're not, you're going to be in a world of trouble. And I think to that end, the compensation strategies is the same issue. That you've got 3 pieces. You can have a base salary that's kind of market rate, which you can't afford. You've got an equity vesting schedule that should have a waterfall to it after 1 year, and 3 years, 4 years, the typical vesting period. And you should have on your cap table, and I know people are going to gulp when they hear me say this, but Mitch and I say this all the time because we talk to VCs and they tell us the same thing. You better have 10% of the equity of the company set aside for employees. That's another tell to VCs that you don't have your act together, right? And that's important. And sometimes it might even be 20%, right? And I see a question coming up from Alicia. What's the most critical hire for a pre-seed startup in the area of sales? Yeah, it's the sales director, because they're going to be like a Swiss Army knife. They're going to have to do a lot of things until you get to scale. So that hire is the number one hire. Next would be customer success. And then third would be obviously finance, would come in that order.
But when you say director, you're not saying like huge heavy hitter, right?
No.
Like a more malleable, they still feel like they need to learn, in the process, et cetera. Right?
Yeah. Don't hire a CRO out of the gate. That's not what you need. You need somebody who's going to go out and sell.
Sometimes not even a VP of sales. So I'll use the analogy. We got to get, so it's like the CTO. A lot of people are like, oh, well, the VC says we need a CTO. And you're like, no, you probably need a director of engineering. The CTO you want to hire, they don't even code anymore. They code a little bit, et cetera.
Right.
But they got the bigger picture and they know how to answer all these other questions way faster. But you kind of really just need a director of engineering. And you may just need to tell them, look, you can play the CTO role for the VC deck and everything else, but you're probably just you're really just a director of engineering who's very inspired, who will take that lower pay and will do those stuff and can do all of it. Code, set up the devs, all the dev, the QA, because they work their career up there. Most people just need a director of engineering. Unless you're doing breakthrough, scientific. If you're just cobbling up other stuff and you're just doing, like systems engineering architecture, you just need a director of engineering. They're going to be gung-ho, they're affordable, but they're kind of like this director of sales. Kind of role.
Great. Yep.
And okay, this is yours, Hamp.
So one of the things that I talk to founders about quite a bit is about looking in the mirror. And I use the expression about what do you see when you wipe away the foggy mirror? And you want to do a real good assessment of your strengths and weaknesses and write them down like a journal. And the journal should consist of what you do well and what you don't do well, and then you need to be very honest with yourself and say, okay, I need help in those areas. And that's where having advisors, board advisors, early days to help you navigate that and go out and get help. And I'm not doing this to sell our services in particular. I'm saying in general, you get a coach, get some help, whether it's finance or sales or operations or technical integrations and et cetera. So I think that this is really important. Also, don't talk yourself into making any major decision just to make a statement. That could be fatal. And I think that we see this a lot where people have made some fatal mistakes, and it's really cost them. And my favorite expression is that when it looks like that there's no wind out there, you got to start rowing. That means you. And so that's what you got to do. So I think we left enough time for questions. Did I get to everything?
Alicia has some good questions. But I do like the when there is no wind row. Let me just make sure.
I love it.
Q&A.
Yeah, and before that, I just wanted to thank both of you for that excellent presentation. And I really like that analogy too about when there's no wind, you just got to row. Very nautical. I like that. So we have really great questions here from Alicia. Do you want me to just start with the first one, Mitch, and then we'll go one by one? All right, so Alicia Overton asks, what is the most critical hire for a pre-seed startup in the area of sales?
Well, that's one we already answered. Go to the next one. That was the director of sales kind of commentary we had earlier.
Okay, excellent. When should you begin speaking with your target customer once you have identified them? Example, when your product is just ready.
So there's two parts to that answer. I'll answer one, and Mitch, I'm sure, has got the other. So here's the thing. If your product or solution is at the MVP stage, then you're going to need to tell that first client that they're part of the MVP process and they're going to get special consideration. And again, longer term for free or whatever else, but don't discount just for the sake of discounting. But if it's an MVP and you have it ready, then be very transparent with that first client. And that's okay, because you're going to learn a lot and figure things out about what does and doesn't work with your product or your solution. Mitch, on the other half of that.
Yeah, I mean, well, first let me answer. I think I'm becoming more and more a fan of if you can get, first of all, you need to validate your target customer. So who you think it might be, may not be. And I always probably try to err on the side of the ones who are maybe not the name brand or recognized or even the ideal, because sometimes you realize that you got to find the early adopter. And I would say start talking to them. It's just the way you talk to them, because you could do customer development early on in the process and just start to, ask for advice from them. And then you'd be like, but okay, so where you are in your process on developing a product, and they might give you insights and just kind of where the market, the competition, how they view it. So sometimes those conversations you can have really early on if you're basically just doing pre-sales, and you should do a ton of that, really. And then go back and be like, hey, these guys were kind of more of a customer because I now have an answer to 2 or 3 of the questions that they had or observations that they had. And now I have a solid, and we're ready to go. Hey, you can engage us now. Oh, so now you're trying to sell me. Great. So and now you know what points to. So earlier on in the process, because that target customer you think your target, that's where most people make the mistake. They don't really know who their ICP is or what's going to motivate them to buy and who they really are. And sometimes you don't need to have a product. You can do, if it's software, you can do clickable prototypes. You can show off a lot of stuff without having people just feel a little sheepish. But if you don't have these things anyways, there's no skin off your back. It's just how you approach it. If you're going in for the sale, you might be setting yourself up for, disappointment or getting beat up or presenting yourself in a way where well, I know you weren't really ready then. And I know you have a bunch to prove. So why are you getting all excited and on my case when I know you don't have what we need particularly? Early in the process, the sooner you can get in the process and start scoping out, it's just how you approach it. I think
the other thing, Luciano, I think there was a question from you about pre-seed stage thoughts on aligning customer interviews with pre-order generate revenue. Yeah, if you've got a product, then I wholeheartedly agree that if you're doing social media marketing where you're saying be one of the first 50 customers before we launch, kind of like here's what's behind door number one, like giving them a sneak preview. Everybody loves, to get a sneak preview or some kind of pre-launch situation, especially if there's some kind of 2-for-1 price or whatever you're doing. If it's a product, that's great to generate to book orders to help you with cash flow. If you have a product like that, that's definitely a good idea. The other question was about the advisory board. So to me, as soon as you're ready to go to market, that's when you should start having board advisors lined up, because the VCs are also going to be looking at who's whispering in your ear, because it's not going to be them. You're going to talk to them once a month, and they're going to have a very strict report that they have with you. Okay. So the board advisors are more your weekly calls, and they're your accountability people too. They're going to hold you to the things that you're going to be doing, and they're going to give you navigation tools. The late, great Jimmy Buffett had a great lyrics in one of his songs where he talked about too many mysteries and not enough clues. And I think as a lot of founders, it's okay to have mysteries and not the clues. It's not okay not to ask people to help you find the clues. Really important.
Yeah, I try to answer two. There's a customer advisory board, which you should often do, especially if you're doing the B2B route. But I think, a lot of venture capitals are very easy to dismiss, and I think it's fairly easy now to have a pitch deck with just rock star advisors. And in fact, the more rock star they are, depending on how you're like, they know how to discount it. So let's say you have, I think I use this analogy because I think I saw it. We have the head of AR, VR for Facebook product. That guy has a full-time, because of the guy, has a full-time role. That person has very little time to spend with you. So it looks great on paper, but we kind of know that you have very little of that person's bandwidth. And then take someone like, I have the chairman of American Airlines on our advisory board. Well, please tell me American Airlines is a customer right away, and that person is an investor because they have the money. VCs have a really good eye on discounting the crap out of all your advisors. They're very good at it. So you better be able to defend it. In fact, be able to say what contribution they have or they have already, because it's very easy to get people, yeah, sure, I'm curious, or whatever, especially if you give me equity, which you shouldn't do right away. That's going to be very expensive. So you got to be very careful. They know how to discount those advisors very quickly.
I know we're coming to the end, so I left some secret sauce for the end for everybody. So if you're taking notes, make sure to write this down. What I'm about to say. So Mitch and I have been on so many calls where we've teed up founders to have that initial calls with the VCs. And sometimes the presentation does really well, and sometimes it doesn't. And somewhere in between is usually about 75% of the time. But the one thing that I can impart upon everybody here is the following. You cannot be eager or give a sense of anxiety when you're presenting to institutional investors. You want to use what's called the takeaway close. Mitch had set this meeting up, or Hamp had set this meeting up with you, Susie, Frank, Joe, whoever is at the VC. And this is really information. We're really busy on revenue and we're busy on our activities, but I want to take the time for you to know about us and keep us on your radar, because right now we're really in the revenue stage game. So you're taking things away from being so earnest and so intense on got to get the money by Tuesday to make payroll or whatever, is when you take away this sense of urgency and you put it on the perspective of, hey, I don't want you to feel like you're going to miss this opportunity. So Mitch and Hamp asked me to talk to you, but I really am not ready to take your money. When you get in that mindset, you're going to be very successful. Because as my wise grandfather once told me, opportunities are never missed. They're simply taken by somebody else. We thank you for your time today, guys. Hopefully this is helpful.
I thank you for your time today as well, gentlemen. And before I take us out, I just wanted to give Mitch the opportunity to talk about our next series, which is going to be coming up on Wednesday, October 25th, once again at 12 Eastern, which is going to be the Voyage of Customer Discovery, mapping the path to readiness with Steve. Yeah, Mitch, go right ahead.
Yeah. So in the vein, as we started doing our, been doing this founder advisor thing for a little over 3 years. Again, the aha moment started to happen around like really the best way we can help founders is go to market. And you heard me say something about like really just zeroing in on who the right ICP is and take your ego out, especially if you can close that ICP all day long. Do that and then build and start targeting some of the other ones. But mostly it's the team or the founding team is doing inside out product management and or sales process. And so what Steve and Roger are going to be talking about is customer, like how much customer journey mapping should you do as you grow? Because eventually you're going to just be doing it all the time. And then there's sophisticated ways of continuing doing it because as you heard Hamp say, like that onboarding process in the first 90 days, and you hear people, especially in the product-led growth side of the quadrant, how do you get people to find that first aha moment, that first moment of truth? Well, customer journey maps all of it, not just your product. It's to say everyone gets scrutinized. And then that whole process gets mapped with like, is this like how important is this phase and how well are we doing it? Because that's how you then start doing performance because you now know how important that whatever that moment, that key step is. And then you can start fixing it. So you can put resources against it because if that does well, people move down the funnel of engagement to the point where they're like actively referring folks. So that outside in product management / more than just product management is so key. And so that's what Steve and Roger are going to be talking about. And that could potentially really help you figure out who these ideal customer profiles are. And then what's the team to go chase those, close them, get them happy, get them to the point where you can, do testimonials and referrals and whatever other testing you're going to do and build upon that base. And so that's what's going to be with that talk. But it's very much go to market because as soon as you do that and you do it well, you start layering in more. It's a resource constraint in the early stages, but you still need to have that awareness as a founder that you probably need to be doing it ongoing. And then definitely as you go and start hiring teams, because that's kind of the more company-wide dashboard of activities generally is around that journey mapping. And then you're always putting the voice of the customer first. And everyone can agree with that versus pointing fingers at departments or egos on the team.
Definitely. And I love all of those highly resonant and salient points that you raised there, Mitch. So, everybody, it's been an absolute pleasure spending some time with you this afternoon. I'm so excited to be embarking upon this partnership with these amazing, knowledge experts for the Boston New Technology community's collective benefit, as well as the whole startup ecosystem. And we will see you again soon. Thank you once again for joining us. This recording will be made available to all of the attendees, and then we'll be putting it up on our Boston New Technology YouTube channel very shortly. So thank you once again, and have a great day.
Hey, and we'll 1 second though, Steve. I've just put in our LinkedIn profile.
Perfect. Thank you.
Question is asked.
All
right. Thanks, everyone. We'll do it again. Cheers.
Bye.